Q3 earnings season ramped up in a big way this past week, with reports coming in hot from many popular stocks, including, by the way, Tesla. Now, I'm actually not going to be talking about Tesla for today's video because I'm actually going to do a whole separate video on Tesla. Their earnings were pretty alarming, raised some concerns about profitability and even competition. A lot of people are discussing that, kind of arguing over it. So I decided to just make a whole dedicated video on just Tesla alone to discuss all of that. Should come out hopefully soon, so please keep an eye out for that video. But for now, I just chose 5 other stocks that are very large, very popular. I often get comments asking about these stocks. And so we're going to run through their earnings today, and I will give you my opinion on them. We'll take a look at how they're performing. And as always, I'll even let you know if I'm investing in any of these stocks too. So it's going to be a fun, interesting one. Let's go ahead and jump straight into it. All right, now we'll be running through these in chronological order from when they reported. So if you want to jump around the video, I did add chapters for you down in the time bar. Let me know if you like having chapters, by the way. You can let me know by hitting that like button, and I would really appreciate that too. But taking a look at these, I didn't pick anything from Monday. However, from Tuesday, I did choose to review Bank of America since they're the second largest bank. And we just had banks, some other big banks reporting the week prior, and they had a pretty good showing, like Chase, Citigroup, and Wells Fargo. However, all of them gave big warnings about the economy, so we'll see if Bank of America had anything to add to that. And then I also chose Lockheed Martin since there's unfortunately and very sadly a lot of horrific war and conflict that is going on around the world right now. So, we'll take a look at how that might be affecting one of the biggest defense companies out there. It's very tragic what's going on out there. I hope you're all staying safe. But from Wednesday, I did also pull out US Bancorp, the 5th largest bank, and from Thursday, I pulled out AT&T, who has a gigantic dividend right now, but their stock is trading like at a 30-year low. I mean, they've been crashing so much. So that might be an interesting one to look at as well. And then I also pulled Taiwan Semiconductor, who is one of the largest and most popular semiconductor stocks in the market too. And of course, chip stocks have been having a rough year, tech stocks in general. So we'll see how that kind of sector is performing and how Taiwan Semiconductor is doing as well. Okay, let's go ahead and kick things off though with Bank of America, ticker symbol BAC, who, again, this is following other big banks that recently warned about the economy and lingering inflation and high interest rates that could cause a recession soon. And by the way, I made a whole video on that. If you do want to learn more about it, you can check it out. But as far as BAC goes, they too had a very similar showing this past week, beating on both the top and bottom line. Like usual, I mean, they're one of the best run banks in the world, so they usually do very well. And year over year, it also translated to a 5% rise in net income and a 3% rise in sales, which was pretty much entirely boosted by the high interest rate environment that sent their net interest income soaring by 15%. However, non-interest income actually fell by 3%, which kind of shows you that if it wasn't for the high interest rates that we have right now, I think a lot of these banks would for sure, not be performing as well as they are. Still, the temporary boost was enough to lift the stock up a couple percentage points on Tuesday. However, it later retreated to actually finish the week in the red, leaving the stock still down over 20% this year and close to half its total value from the top. So it is down a lot. And there's several reasons for that. For one, just like the other big banks, BAC has also been warning about the economy. In fact, during an interview with CNBC back in July, the CEO had predicted a mild recession would occur during the first half of next year. And earlier this month, during a speech, he also mentioned that the economy is healthy but slowing down, also noting that the Fed will have a hard time trying to bring down inflation without causing a recession because of the rate hikes. Normally, a single person giving warnings like this may not grab much attention, but when it's the CEO of the second largest bank and it's also in tandem with other big banks too, then yeah, we might want to start paying attention to these warnings. Now, fast forwarding to this past week, during the earnings call, the CEO again talked about an economic slowdown, noting how impressive it was for them to still be adding clients clients and accounts across all lines of their business, despite the challenging environment and slowing consumer spend. While I personally agree that BAC is performing relatively well, though, another reason for the falling stock price has to do with unrealized bond losses that are growing each quarter, and this quarter was no exception. And of course, these unrealized bond losses are something that have sunk smaller banks earlier this year. Now, personally, I think Bank of America is well run and large enough to be able to hold on to those until maturity, so I really wouldn't worry too much about those if I was investing in the stock. However, I still prefer JP Morgan Chase as a safer alternative and US Bancorp as a bigger value. And Chase, of course, being the largest bank with the most return on assets and return on equity, while US Bancorp is admittedly much smaller, but it carries a cheaper valuation with also a much larger dividend yield. I'm not a huge fan of bank stocks myself, by the way. I only invest a small amount in them, but Chase and US Bancorp are still my favorites. And we'll come back to US Bancorp in just a second when we look at their earnings. But for now, let's just finish up Tuesday with the earnings from the defense giant Lockheed Martin, who can probably best be summed up as a very slow but reliable performer, as they usually beat on both the top and bottom line, this quarter being no exception. However, it was only a very small beat of just around 1 to 2%, and year over year their sales and EPS only slightly rose as well, while net income actually fell by around 5%. Now, the drop in profits has to do with a few restructurings and lingering supply chain issues that continue to affect how many aircraft they can produce, which caused their aeronautics segment to fall over 5%. But those are really just temporary issues that shouldn't worry any investors too much over the longer term. In fact, it really just shows how high in demand they are, with most segments seeing robust growth, like missiles and fire control rising 4%, rotary and mission systems climbing 9%, and space, which is very important for the future, also rose about 8% as well. And speaking of the future, they're building up a gigantic backlog of orders that grew by another $6 billion this quarter, reaching $156 billion in total now. Now, this is, of course, largely being boosted by all of the recent war and conflict, namely the Russia-Ukraine war, and then more recently, there's the huge conflict going on between Israel and Palestine. All of this is kind of causing nations to order more weaponry and boost up their defense systems in fear of a global escalation, which would just be, the worst thing you could imagine. But, so far that's going to be benefiting defense contractors like Lockheed Martin. In fact, according to the Center for International Policy, they estimate that Lockheed Martin generated close to $7 billion in sales just from the Russia-Ukraine war alone last year. And that's already grown to a whopping $10 billion this year as well. So as sad as that is to say, they're obviously going to be a big beneficiary of all this. And they're using a lot of those profits to also buy back their own stock, as they increased their share buyback program this quarter by an additional $6 billion, bringing it up now to $13 billion in total. And looking ahead to next year, the CFO during the earnings call said that they'll likely still see that pressure on the supply chain, resulting in just low single-digit revenue growth for now, but they should start to convert some of that gigantic backlog next year and slowly start to accelerate their growth over time. So basically, getting some of their supply chain restored, getting that under control, and then using their backlog, their huge backlog, to add to their growth over time. Which is really what you would typically expect to see from Lockheed Martin. It's that kind of reliable, steady performance, even during shaky times. It's kind of a recession-proof type of business in a way, because unfortunately there seems to always be conflicts going on around the world, and that drives up defense budgets. And it's why their EPS is expected to grow nearly 13% on average through the next 5 years. As a result of all this, though, the stock has climbed by around 13% over the past 10 days or so, and is still trading pretty close to an all-time high. And yet, despite that, they somehow still trade a little cheaper than the sector, with also a pretty good dividend to go along with it. Not a huge yield at just under 3%, but some pretty good growth metrics on that dividend for the longer term. Again, I've never owned this stock myself, and I'm not really sure why. I mean, it does have a good valuation for a very resilient and reliable business long term. Unfortunately, that business, is tied to all the stuff that's going on right now, all the conflict and war, which is heartbreaking. It's so sad and horrific, and it's the unfortunate reality that we live in. And of course, my thoughts and prayers go out to all the innocent people being affected, and I hope that you're all staying safe out there too. But just looking at it from an investment standpoint, my guess is that it will probably perform well as a stock long term. I don't own it myself, but I'd love to hear your thoughts on it. Let me know what you think about it. Maybe I'll own it in the future, but I don't right now. Yeah, and I don't know if there's much else I can say about it, but we'll just go ahead and move over to Wednesday now. Okay, now I'll keep this one very short here because we've already talked a little bit about banks, but when looking at US Bancorp, ticker symbol USB, in my opinion, I think they had a really strong showing, not only beating on both the top and bottom line, but they also showed strong loans growth above 10%, even with the weak economy. They kept expenses flat and under control, which helped their profitability. That was also boosted by their net interest income expansion, and they even grew their non-interest income by 3%, which is something that many other banks have actually struggled with. Plus, on top of all that, they also managed to control their asset levels after the Union Bank acquisition, which granted them fewer regulatory restrictions from the Fed, which management highlighted in the earnings call, saying that it's extremely helpful as it now gives them more flexibility during the challenging economy and will put them on an even playing field against rivals. Initially, the stock did rise on the report. I think at one point I even got a notification on my phone that my stock was up like more than 10% on the day, but it quickly fell right back down right after, and it's now still down almost 30% this year and well over half its value from the top, leaving it at just about the lowest price that I've seen in over a decade. I would honestly go ham on this stock if there wasn't such a large chance of a recession hitting, because banks tend to get destroyed during recessions. But for now, I think I will keep buying this one in very small amounts the more that it falls, because that dividend yield above 6% is just way too attractive for me to ignore. It's trapping me in, that's for sure. I think when the economy recovers, though, I think USB stock will perform a lot better. I do expect that. Okay, with that said, let's go ahead and finish up here with Thursday. So we had Taiwan Semiconductor and AT&T report on that day, and I'll just start with TSM first. This is one of the biggest chip makers in the world. They make chips for companies like Apple and Nvidia, and they saw explosive growth on both sales and profits during the pandemic when demand for computers and processing chips went through the roof. However, coming off of that huge growth, the PC market has seen a substantial crash, with global PC shipments falling about 30% in the first quarter of this year and another 17% in the second quarter as well, according to Gartner Research. And as such, TSM's revenue is actually expected to fall by over 20% this year. But like I said, this should really just be a temporary setback, with next year already returning to record high sales expected. And that was really the focus of this quarter's earnings report, as profits saw the biggest drop in nearly 5 years, falling almost 25% year over year, with sales also falling over 10% as well. However, both figures still beat analyst estimates. Sales still rose about 14% over the previous quarter, indicating, a recovery may be taking place here. And most analysts are now saying that chip inventories are starting to run down, with restocking demand starting to come back. So next year should see a substantial recovery, which the CEO also pointed to during the earnings call, saying that they are seeing the early signs of demand stabilizing. Stock-wise, TSM rose about 3% the day of reporting and is so far up over 22% this year and has more than doubled in the past 5 years, although it is still technically down close to 40% from the top. And to my surprise, valuation is actually really good right now, around 10 to 20% cheaper than the sector on a PE ratio basis. I actually used to own a pretty big position in TSM stock, which I do regret selling now because it's been a good performer. My old school viewers might remember that I used to own this stock. But I might consider buying back in soon. I do think that it's a solid growth stock that is currently cheap right now, and I can only imagine how much better they'd be performing if the macro environment was more favorable to them. So it's definitely very high up on my radar right now. Let me know what you think about it down below. All right, guys, we're running a little low on time here, so let's just finish up really quick with AT&T, ticker symbol T. I actually used to own this one too until they cut their dividend in half, but this is one that I actually don't regret selling because it's been a horrible performer. Just really so many poor management decisions over the years, like spending around $50 billion on DirecTV and $85 billion on Time Warner. It was a lot more when you include debt, and that was only to later divest in them later on, so it was kind of meaningless. Plus, they've seen increased competition, namely from T-Mobile, who's been stealing a lot of market share from their wireless business, which has caused just really so many years of revenue declines. However, this quarter looks to have impressed investors a bit as the now slimmed down wireless leader focused more heavily on promotions this quarter, which did help them add around 70,000 more wireless phone subscribers than analysts were expecting. And thanks to stronger than expected iPhone and electric vehicle service revenues, they were also able to beat expectations on both the top and bottom line, while also raising their full year guidance for free cash flow as well, which is great to see as that figure has been in decline for years and it's an important profitability metric. In all, it was enough to lift the stock by over 7% this week, although it is still down over half its value from the top and is trading at one of the lowest prices that I've ever seen in it. This does, however, leave it with a dirt cheap valuation, though, that is over 50% lower than the sector now, and a huge dividend on it too of above 7% of a yield. I have to admit that this one is starting to get a little attractive here as a turnaround potential play for a world leader like this. However, I still think that Verizon is the better choice, as they have just about the same PE ratio, but they are consistently being awarded more quality of service awards than any other competitor, and it's like not even close. They always win on quality, and that's led to more sales than both AT&T and T-Mobile. They're also expecting a smaller drop this year than the other two on sales growth, and they're more profitable, and they even have a bigger dividend too of above 8%, which is just gigantic. Now granted, both could very well be value dividend traps. That's always the risk you take with stocks that are falling hard like this. But I'm still buying small amounts of Verizon stock myself. I think longer term, it's just a little hard for me to envision them not being a leader or kind of disappearing or having anything really catastrophic happen to them. I think in a better macro environment, they would be performing a lot better. But we'll have to wait and see. For now, I am buying a little more the more that it falls, but we'll see how it does. Anyway, I think that'll just about do it for this week's update. Make sure you subscribe so you don't miss next week because we've got some of the biggest giants reporting. We've got Amazon, Microsoft, Google, and Apple all reporting. I think Meta too. Like they're all reporting in 1 week. So you don't want to miss that update. Make sure you're subscribed and hit the like button if you enjoyed the video. Thank you for stopping by, my friends. Thank you for all your support. Hope you're all doing well out there and especially staying safe with all the craziness going on around the world. But I will catch you in the next video, my friends. Take care. See you next time. Bye-bye.